Good evening, everyone. Thank you for your attendance. I really appreciate it. I am Sensei Kevlar, and I am here to speak to you tonight about the way of the trader. Um, Starting with a couple of corrections. Yesterday I was doing some math, and I got some math wrong. That 43 should be more in the lines of 20. Brian had a really good suggestion, which is that I move it all into a spreadsheet, which I've done here. And if anybody needs, they can, send me an email, and I can send them the link to the spreadsheet so they can kind of see how the numbers work and how when you play with it, some of the numbers change, and as a result, the RSI goes up when the price goes up, and take a look at it that way. But I want to go back to some fundamentals to start with, of course, as I always do. Also, Brian asked a question before we get started here. Where are the donuts you were promised, Brian? Coffee's for closers, so sit back down. I want to talk to you about the mindset of the profitable trader a little bit more tonight, and start out just spending a little bit more time on that this evening. And I hope you'll stick with me, because I think this is something that's really important to discuss and really important to practice. The mindset of the profitable trader, I will remind you, is that a profitable trader wants to be profitable. Therefore, there are certain things that a profitable trader must do in order to ensure that profitability, especially long term, right? It happens that sometimes in the market we make mistakes and a trade goes against us, and that needs to be okay, and we need to have a strategy for dealing with that. We need to plan for that type of failure in order to turn that type of short-term failure into long-term success. And that is the goal of a profitable trader, to stay in the game and to keep making money. So how do we do that? We make a study. We find indicators that tell us what the market's going to do. We make a case for it. We build support. We back test. We forward test. And we trade. This is the plan, the way of the profitable trader, to make a plan. And there's an old saying that goes, if you fail to plan, then this is planning to fail. And I really do agree with this, because if you don't have a strategy to keep you in the game when you learn and when you make incorrect decisions, this can be detrimental to your portfolio, and you really need a way to make this work. So the profitable trader will practice these things like any athlete would. When you're learning an art, you're not going to go and just jump in a martial art. You're not going to go and just jump into the fighting pit. You're going to hit some target dummies first. You're going to practice your moves. You're going to build some muscle memory. I really, really strongly encourage this. Yesterday I made a prediction towards the end of my video. It turns out today that that prediction was totally correct. And if you had, done that on paper, you could look now and see that at 241 we went to 235 today, and I had said short. Apparently this went against a couple of people's signals, and I really want to point out that that doesn't make their methodology any less valid than anyone else's. Any methodology which makes you profitable over the long term is a valid methodology. That's the point. So there isn't one true way, and there isn't one true signal about which way the market is going to go. In fact, the whole point of this is to be able to make up your own mind about what you think the market is going to do. And that's what I'm trying to do, is I'm trying to give you the skills to do this, right? Rather than relying on what somebody else says, trying to put you in the control, because ultimately you are the one who's going to be pushing the buy or sell button. So I think it's important that you are the one who is responsible for making the judgment and not putting that burden on somebody else, because ultimately they can't be responsible for you pushing the button. So I don't suggest you take my trades. I suggest that you take them on paper and you see if the methodology works for you. And if that methodology does work for you, great, that's wonderful. But it's not my methodology at that point, it's your methodology. And that's what I'm trying to describe here, is a way for you to make yourself profitable, because that is the way of the profitable trader, one who plans for profitability. So I get people who they hear this and they see this and they say, oh, look, I just went and I looked at the markets and look, it did exactly what you said it would do. And I think I'm going to go, look, I think it's going to go, it just went down and I think it's going to go up now. In fact, it's obvious. It's totally obvious to me that it's going to go up. I'm going to go put my trades in the market because it's really obvious to me. You know, just like you said, I'm going to put 3 trades in and I'm going to say to you, whoa, hold on there, right? A profitable trader doesn't need to jump the gun. A profitable trader can plan ahead. He can plan to be profitable, and he can demonstrate that he already is profitable on paper, because he can just write that trade down and then see if it worked. And then he can prove time and time and time again, am I going to be profitable? And that's how you can prove to yourself that when you go to do this, you will be profitable. And that's the plan, right? Not to rely on somebody else's wisdom, but to build your own set of wisdom and your own understanding for how to read the market. So when I show you a signal, or when I show you, you know, especially some math, hey man, I'm human, I can get it wrong. I really invite you to go and learn more about this, because what I'm trying to describe to you is a methodology which has you constantly exploring, has you constantly learning new signals, has you constantly learning new indicators, has you constantly aggregating all of the information that you have available to you in order to make the most informed decision that you possibly can, and how to derive strategies out of that information, how to trade in such a way that that information ultimately will make you profitable. And that is the way of the trader. So let's take a look at some more signals here. Yesterday, we took a look at the RSI signal, and that's a really cool one, because what it does is it correctly measures when the market has recently given off more than it's put on, or the other way around, recently, you know, gone up more than it's gone down. And so it's a really useful indicator of what the market is doing. Now, there's a lot of other indicators for this. The MACD is a really common one, the moving average convergence divergence. And I really recommend that you spend some more time and look into more indicators, and more importantly, break the math down for yourself and spend time with it. And, you know, I'm happy to do that with any of my students. But break the math down and figure out why this signal is what this signal is telling you, and why it's telling you that. So that's one form of signal, sort of the mathematical signal, and we call this a lagging indicator. I'm going to talk a little bit more about types of indicators now. We call it a lagging indicator, the relative strength indicator. And the reason we say that it's lagging is because it requires a full set of data, and it isn't until after the move, after the big move down, that the RSI goes below 20 or below 30, whatever it is, right? And it's not until a big move up that the RSI goes to 80 or above 80 or whatever it is that it's doing, right? And so let's take a look at what I'm talking about here. I'm just going to pull up TradingView. I'll go to the BTC USD at Bitfinex. We'll make that full screen. Okay, here's our RSI. Now, here's the RSI coming way down again after a recent fall. It does this every time we have a fall, right? The RSI comes way down. That's what it's measuring, is it's measuring that the market has recently given off a lot, okay? So here's another case where the market, you know, gave off a lot. And if my screen would like to refresh itself, that would be great. There's my RSI. Okay, here's another case where the market has recently given off a lot, and once again the RSI is signaling around 20. Okay, the point of this is it isn't until after the market movement. See, here's the market movement right here. Here's the market movement, and here's where the RSI is signaling. They're exactly the same, right? It isn't until after the market has made the motion that the signal becomes relevant. So we call this a lagging indicator because it requires a full set of data in order to find that information, in order to indicate correctly. Okay, so there's other types of indicators. There's another form of indicator called the predictive indicator, right? And the idea behind the predictive indicator, I'm gonna zoom in on the 15-minute chart here just a little bit. The idea behind the predictive indicator is that the market is in constant patterns, and when the market goes into a specific pattern, it tends to, and this is certainly no silver bullet, and I'll talk more about where these things go wrong towards the end of the discussion here. It tends to complete that pattern when, and the reason for that is because other traders are, first of all, these patterns are based in real world patterns based upon actual behaviors in markets. So you see them across markets, and they're very common. The other reason that they tend to happen is that other traders are looking for them too, and when they trade those patterns, the market tends to move in those directions because they're trading with the pattern, which causes the pattern to become true. So what am I talking about here? Well, one of those patterns, I'm just going to, throw it out there. And again, this isn't to say that every single time the market makes this motion, this is really going to happen. It's simply that we can use it as another indicator if it happens consistently, if it happens in a way that we can measure it. Okay, so the pattern that I'm going to describe is the basic pattern of the head and shoulders pattern. So the idea behind the head and shoulders pattern is recently we've made a large move upward, and then we're going to come back down, and then we're going to make a second larger move upward, and then we're going to come back down to somewhere within the same area that we had come up before, and then we're going to make a third move upward, but it's not going to be as high as the second move. So that's the pattern. The first move up, the second move up is higher than the first move up, and then a third move up, but the third move up is lower than the second move up. Okay, so we call this a head and shoulders because it forms a head and shoulder pattern, with this being the left shoulder, this being the head, and this being the right shoulder. You can even find it right here. Okay, so let me draw in what I'm talking about. I'm going to find the head and shoulders pattern over here in TradingView, and I'm just going to do it right here because this is where it came back down to show you the completion of the pattern. Okay, here's the left shoulder, here's the head, and we're going to do this right here. Here's the right shoulder. Okay. Now, what's interesting about the head and shoulders pattern, I'm going to zoom in a bit here so we can make this a little bit bigger. Is you've got a couple of trends that are informative here, right? The first of the trends that's informative is that you are making a move upward, but that movement ran out of steam. Okay, you were trying to go up, but then once we made that third push up, we simply didn't have the same momentum that we had during that second move up to 243.59-ish, 243-ish, yeah, a little over 243. We simply didn't have it later on that afternoon, that evening, right? It wasn't there. It wasn't available to us, okay? So what you can say is that when the other trend that's interesting is you have this trend line right here, which has formed, right? you have this trend line right here, which is formed, and this trend line right here, which is formed. And I'll just go ahead and draw that in. Okay, so you've got a consolidation pattern. Consolidation is where the market is moving in a sideways pattern because the whales are usually accumulating or dumping in order to position themselves where they want to be, and the market is positioning itself for a large move in either direction. So when we have this pattern, what we can do is we can say, you know, here we are. Let's put us back a little bit in time, right? Is we went up, we came down, we went up, we came down. I'm looking for a return. So this line and this line you can draw ahead of time. Okay, I'm looking for a return to this line, to this trend line, in order to signal that the pattern has begun. Okay, so there's that return to that line right there. Okay, I went ahead and just, you know, let's do this again. Let's draw this line ahead of time when we don't know, you know, what the market's going to do. Okay, we're going up and we're going up, and we're saying, I wonder if we're going to see a head and shoulders here. Right? I wonder if this is a market top, because that's what we're going to signal with a head and shoulders, and I'll show you why. Here's the left shoulder. Here's the head. There's that line right there. Okay, that is what I am looking for. I'm looking for it to come up to here. I'm out of chart, but I'll just give myself a little bit of chart here. I'm looking for it to come up to here and then come back down, right? And I can do this, you know, pretty much on any time frame that matches this sort of time frame right here. So if this is, you know, this is from 8 to 11:30, then you're looking for 11:30 to 2 or something over here for the completion of the pattern. Okay, so we went ahead and we drew that line. We're going to go ahead and bring this line out. We can bring these up to the candle closes. Okay, we're looking for it to come back down and touch here, right? Looking for it to come back down and touch this and come back up. And if it does that, you know, if we can get that type of pattern to work for us, what that means is when we are here at the right shoulder, right here at the right shoulder, and we start to come down, we know that we can expect more downward movement. Okay, let's see if we can find a better example of this. I'm going to zoom the chart out a little. Not finding any on the 15-minute chart. Let's switch to a different time frame. There we go. Right. Here's a good example right here. See a couple of good examples. The left shoulder, bring it up to right there, right? The head, the right shoulder, okay? We can expect a return to at least this trend line. And what's more, we can probably expect more downward movement beyond, okay? So this is always a reversal pattern, and it definitely works in inverse as well. So let's get rid of this one and check this out in the inverse mode, okay? Instead of going up, we're going to do it when we're coming down. We come down, we do a little bounce, make the inverted head, come back up, do a little bounce. We're looking for a return to here, right? You can find these things up in here. You can find them here. You can find them in all kinds of locations. But the point is that when you see that you are here on the chart, when you're on the shoulder of this, let me just zoom in a bit. There we go. There we go. That's perfect right there. When you're on the shoulder of this, the right shoulder right here, you know that you can expect a trend reversal, right? Because here's the point that I want to make. When you were coming down, you hit support here, and then you broke through that support, but you quickly made a return to it. The market said, no, I think I like to buy it at this price. I'm going to go ahead and buy it on up, okay? And then what did it do? Quickly made a little return to where? The previous support line. And that's the point. These support lines right here on the left shoulder and the right shoulder, highly correlated. That's where they made their returns to both bounces. Here they broke through and it made an immediate return to it. Did not like being below this line. Okay, and now we're here. We made another bounce. We know it's time to turn around. Okay, this is a bounce pattern, right? When this happens, usually, and this is not, again, I'll just say it again, it's not a silver bullet. Usually when you see this type of pattern, it means that the market is going to undergo some form of reversal. See if we can find it again in the recent history. Here we go, right here. Yeah, perfect. Left shoulder, head, right shoulder, all the way on up. Okay. Here we are coming down. We know that we came down a lot. We've given off a lot recently. We seem to have found some support at this level right here. We went back up and we broke through that support. And then we found some new support right here. And when we came back through that support, we had no problems passing right through it. Okay? So when we're here, when this is right now, when we are here in the pattern, right here, this is a strong buy signal. And the reason for that is the market is showing support at this level. Okay? And sure enough, as soon as this happens, we're taken off to the moon. Okay? Now, what you want to do is you want to make this a part of any good strategy. You want to correlate this with other indicators. Let's take a look at what other indicators are showing us. The RSI has recently shown us a big sell-off. It thinks that, you know, on this, especially on this chart, let's take a look at this on the 1 hour chart. Here we go. On the 1 hour chart, you can really see the big RSI dump right here. The RSI says, you know, I think that we're just completely oversold at this point. I think we can expect some return back upward. And sure enough, the RSI was completely correct about that. The support was found once, twice, broke through, came back, found support again. This is a strong indicator. It found support again. And that's what you should be seeing, right? Is it came down, went up, came down, was unable to come back down through here. This is a strong signal that we're going to be headed back upward. Okay, so even if you wait for this, even if you wait for it to do this little nastiness right here, you come back in and you look at this one right here. What about this one right here, right? Now we're even above the support line. This is a clear trend reversal right here, right? Let's draw that in. Okay, so there's the trend reversal right there. Previously, we had been doing time after time after time after time of trend reversals. Or, I'm sorry, of movements down, drives down, right? Driving down, driving down, driving down. Here we went down. Looks like we could just be driving down more for all anybody knows. Okay, when we're here, this is, you know, if you want to go ahead and go long here, I'd call that, you know, catching a falling knife is what I'd call that, because you're just as liable to keep on headed on downward as you are to go upward. You don't really have any good indicators that this is a market bottom yet. right? This is a strong indicator that you have reached a market bottom. When you come down, you break through, you come back up, and then you can't get back down that high, that low again. You come up, and you come down, and oh, you just can't do it anymore. It no longer has that momentum to break through that. There's the strong indicator. Okay, that's your strong buy signal. So these types of patterns are available all throughout the market. Here's another one right here. Just draw that head and shoulders in real quick. There's the left shoulder. There's the head. Here's the right shoulder. Okay, let's just say I'm here in the market. Right? What do I think the market is going to do? We've been coming up. We've been coming up. We've been coming up. Finally, you know, we came up and we just can't come up anymore. Thought this was going to work for us, but you know, we were doing all this and now we ran out of steam, right? Okay, what's the RSI telling us? The RSI is telling us that we've got a lot of we've got a lot of things that are overbought. Now it's possible to find the same thing here, right? And there is a small motion downward here. Okay, so what you want to do is you want to find places where the signal forms strongly and make a note of those. So I'm going to talk a little bit about you know, the strength of a signal here. When you're doing your back testing, part of the idea behind the back testing is, you know, to prove that your strategy is profitable. Another part of the back testing is that once you have proven that your back testing, your strategy is profitable, is to remove emotion from the trade. If the strategy is profitable, we don't need to be have emotions about our decision-making process. There's no need for this, you know, this inclusion of our personal feelings about why something did or did not happen. The market can do strange things to us, and that's what I'm going to talk about a little bit right now. What happens when these signals go completely awry, when these patterns look absolutely perfect and they go wrong? Because I see I have a question about, could you show why the head and shoulders pattern didn't succeed on May 8th through May 10th? I will get to that in just one second, but I want to talk a little bit more about sort of the overarching reason why, you know, technical analysis fails at all. Because there's a couple of really good reasons. The number one reason that I find that technical analysis fails or breaks down in some way is because you don't backtest enough. The fault is yours, right? If you had simply gone back a little bit further, you would have seen that the market conditions that made this signal profitable no longer exist in the market or recently came into existence in the market, right? And the signal only became valid when those set of conditions became valid. Maybe those set of conditions are news or market sentiment. Maybe those set of conditions are you know, the U.S. has gone to war or something, okay? Which brings me to the reason, too, that technical analysis fails. News. I'm not even joking in the slightest, right? That is the most obvious thing that I see that happens all the time, is all of the indicators indicate one thing is going to happen, and news comes along and happens, and the exact opposite happens. It's incredible. News is like the anti-technical analysis. Market sentiment can push the market around just as much as it wants to, and it can completely ignore every indicator and every pattern that you've ever seen before. The market is liable to do weird things. It can move in new directions. It can, you know, do all kinds of really strange things to you. Which brings me to my final word of caution about this. This is a cowboy market. This is an unregulated market. These are exchanges that are not that don't have the same regulations, and they also don't have the same you know, problems that the markets that are regulated have, and that's part of their value to some people, and that's cool. Certainly valuable to me because it means that they have a lot more volatility. It means that I can have a lot more liquidity, see a lot more profit in a very short amount of time without going through, without risking huge margins. Okay. The other thing is that so what I'm coming to is that in this cowboy market, there are what you call whales, and they can just push the market around. They literally have the power to, with a, just because they're bored, if they really do feel like it, they can push the market around. They can do the exact opposite of everything that you see, and you think should happen, and that has happened in the past, and has happened, and that you think should happen now, and the indicators are telling you should happen. So I will, caution against those things, right? Market conditions change, news changes, whales do things in the markets, and those cannot be predicted, not with technical analysis, not with any amount of studying the charts, not with any amount of, but not with any amount of you literally need a crystal ball to foresee these types of things, right? What some individual is going to decide to do, right? You can't predict those things. So the point of technical analysis is that if you can build a strategy which you can demonstrate to be profitable, that doesn't matter. Because if your strategy is profitable long term, you can simply trade that strategy, trade that plan. You can plan that trade and trade that plan, okay? And that's the point of what I'm trying to get across to you is, don't follow what other people are saying. Form your own opinion. Use your skills, use your technical analysis, use your indicators, use news, use all of the information available to you, aggregate it all in order to form the most informed, most profitable strategy that you can formulate, and then test that strategy. And if it's profitable, go make money. Great, keep doing it, right? But I recommend that you keep modifying that strategy. You keep practicing that strategy. You keep adopting that strategy to new market conditions. You keep adopting that strategy to new market situations when markets do things that you don't expect them to do. So let's go back and take a look at May 8th to May 10th, my request. Here's April. Yeah, it certainly didn't complete at all, did it? Here's what they're referring to, at least I think, is you have the beginning of the head and shoulders pattern. You can kind of call this one the head. And you would expect, some loss here. You would expect like a really big drop right here, right? From this point forward, you'd expect this to keep going down. And instead what happened is this went up, and then, we dumped a bunch right here, and now we're sort of in this consolidation. So this really failed to do exactly what we thought it would do, even though it might have done it a bunch of times in the past, right? Okay, so in order to explain why these types of things happen, you really have to bring in more information. So I'm going to bring in some more information, and I'm probably going to end up proving to you by the time I'm done bringing in that additional information that it still doesn't matter, because whales will do what they want, and news can change things, and news can change market sentiment, and that happens. So having a strategy that accounts for failure, having a strategy that allows for failure, having a strategy that will keep you profitable long term, even when you fail short term, that's really important. And in the final installment of this, I will be talking about hedging and how to, when you really, really are sure of something and you really want to go in big, but you want to limit your risk, and there's ways of doing that and limiting your loss. It can cost you a little more, but it can be worth it when, when you've really got a big bet on the line. So that's coming up still. So let's take a look at some more indicators. One of my favorite indicators to use, and it's not even a roll-up or a derivative. It's the straight raw data from another exchange. So let's take a look at what that looks like. Instead of going to instead of going to the actual chart, I'm going to go to compare, and I'm going to bring in BTC USD. Except instead of going to Bitfinex, I'm going to go to Bitstamp, which is an American exchange. Okay. Now, immediately, this looks a little wonky, and I can tell you that it's wrong. And if you try and use this, you're gonna experience some problems right off the bat. Namely, when you go to drag your chart, it's not going to move like you expect it to move, so that's not very useful, right? In order to fix this problem, here's what you got to do: is when you add a new study to your chart, that study appears right here, and then you have options for it. If you come over and you click on the Bitstamp gear icon in the upper left-hand corner here, and you click Style, you can change the scale down here at the bottom to scale right. And what this will do is this will cause the scale on the right-hand side to be the same as the scale of the candles. Okay? Now, sometimes what happens is, especially on like the really small roll-ups, sometimes these things will predict the market. You will see ahead of time that what you can call the arbitrage here. The idea behind arbitrage is that when the price difference between two markets occurs, a savvy trader can buy low on one exchange while selling high on another exchange. And I've written open source bots for this, which is outside the scope of this conversation. If you're interested, you can get in touch with me about them. The point of this is that this can reflect what the whales are wanting to do. Okay, so here we've got a situation where for a while now, arbitrage on Bitstamp has been below Bitfinex. Okay, and you can see that there was a couple points here where arbitrage really pulled away from the price, right? Did a number of times where they were just like, here on Bitfinex, they were probably, doing some acquisition or something, and then, later on, push the price down. This is whale movement right here, right? Because this just happened in a snap. This was like, a whole bunch. This is just one order all at once, just bam. So this wasn't a whole bunch of people getting excited. This is one person doing this, right? Or one group or whatever it is. I don't know. I don't care to speculate about that. The point that I'm making is that what's happened is, if you look, almost immediately, arbitrage has now shifted above. Okay? This can be a strong indicator of what the market wants to do next. So can we backtest this strategy and incorporate it into our thinking here, right? So let's go take a look back a little further here. Let's bring in some more data. And let's take a look at a time when the market was headed up. What was arbitrage doing at the times when the market was headed up? Well, arbitrage seemed to be, quite happily above. And then what happened when it was below? Well, arbitrage seemed to pull away from there, right? And here, we were trying to head up, and arbitrage was very much in line with it, okay? And here, we were trying to pull away. You can definitely see ahead of the big sell on Bitfinex, some arbitrage pulls in this direction, right? So, this is one way of thinking about the data. There's definitely other ways of thinking about it. So let me take a look at that style again. Instead of doing instead of doing the price from another exchange, we can actually do something a little bit more interesting. You see, there's exchanges out there now. It's a fairly recent development within the past year or so. That futures have really taken off, and future prices are now available, and they can be quite revealing too. So let's see how we pull those up. We go to BTC USD, and we can pull up the futures of BTC. And there they are, right there. Okay, so here's the 2-week futures, here's the 1-week futures on OKCoin. And I didn't mean to do that. I meant to bring that against Bitfinex. So let's take a look at the Bitfinex chart, but we will compare it to BTC USD 1 week on OKCoin, okay, which is the other major exchange. And instead of looking at it as candle bars against our candle bars, I'm going to do something a little different. I'm going to turn it into a line. Okay, I'm going to make it bright blue, make it the price line. Yeah, and we're going to add a price line. And what the price line will do is it'll show us our current price is this blue line against our actual price of the futures. Okay, so what is this showing us here? First of all, don't get fooled. Set your scale to scale right. That's the only way this makes any sense at all. Okay. This is fascinating. Okay. The minute I turned it on, it almost jumped out at me. Look at what happened here, right? At this point in time, this is very recent, right? This is the 9th of this month. Here's the 8th. Here's the 7th. Let's start back at towards the beginning of this month. Okay. Look at where futures were compared to the price. Here's a really strong indicator. Futures have pulled well below, the price of futures have pulled well below the price, which makes sense if you know that the price is going to go up, because you're willing to go ahead and sell those future contracts at what otherwise would be ridiculous prices. Acquire those future prices at what otherwise would be ridiculous prices. You'd be losing money if you were to take those and then have to fulfill them at this level right here, right? Okay, but if you knew the price was going to go up, this would be an awesome price. Okay, now here, the futures wanted the market to go down, the market went up. Okay, the futures were above and they wanted the market to go down, and the market went down. Okay, so it doesn't work every time, but we can certainly measure some sentiment about this. Here they were below, we went up. Here they were above, we went down. Here they've been above for a while, okay, and then we went down. Once again, now they're below. Okay, so I think that's telling. In terms of a study, this is interesting. It shows that there is some correlation between future sentiment and actual price sentiment long term. So the idea here is that we can use these contracts, these derivative contracts, to show what the long-term market sentiment. Now, somebody asked me what a future contract is. It's a great question. A future contract is the idea that I have a contract with someone. I have a contract that says I agree to sell a commodity that I have at a certain price. Okay. Or alternatively, I agree to buy a commodity at a certain price at some time in the future, like 2 weeks down the line. Okay, so the idea is that if I have something and I paid $50 for it, and I have a contract, and it says I'm going to buy this off of you 2 weeks down the line for $100. Well, that contract itself has value. Specifically, it has the value of the $100 that the person agrees to give you in exchange for the item, minus the cost of the item. So if the item costs $50 and the contract is worth $100, then $100 minus your $50 cost, that contract is worth $50. Okay, so you can now sell this contract on the open market to anyone else who can fulfill it. You know, assuming that they have the commodity in order to fulfill the contract. Now, why would somebody do that? Well, say that they bought their item at $40. Okay, so if they're willing to, if they can pick up a contract that'll allow them to sell it for $100, they can make $60 in profit. So that contract is worth $60 to them, but somebody is offering it up for the low price of $50. Okay, that's $10 in profit for them. So that is valuable to them. They are willing to buy that contract and do it. So this creates a market for the contracts themselves. And that's what we're talking about when I say the price of futures, is we're talking about the price of the contract itself, a derivative contract which allows you to sell or buy the item at a future time. It's a speculative tool. It allows you to say, I have bought and would want to sell the item at this price, but I think I want to buy the item at this price in 2 weeks. But I think in this time, the price of the item is going to go way up. So what I'm going to do is I'm going to buy this contract that will allow me to buy it at the current price. And in 2 weeks' time, when the price has gone way up, I can now exercise that contract and then turn around and sell those items for a tidy little profit. Alternatively, if the price goes down, I can simply chuck the contract in the bin, not exercise it, and go about my way and buy the items at a lower price, because it would be silly to pay for the items at a higher price. So that's the idea behind a futures contract. It's a derivative contract, and it's traded on the open market like any other contract. It's traded using a bid-ask protocol, and it's traded alongside the actual item itself, and so its price tends to closely reflect the actual item itself, minus or plus the sentiment of the market who is choosing to price the item for the time frame that they're choosing, that they want to exercise it on. So when I say 2-week futures, it's our 1-week futures, it makes sense that we're going to buy something and then later on, a week later, push the price all the way up in order to get a tidy little profit on that contract, and then while we're there, we can go ahead and buy up a bunch more, and here we're buying up a bunch more contracts, and then we're going to push the price higher. I mean, take a look at this, right here. The price of futures was under. The market goes up. The price of futures was under. The market goes up. Price of futures is under. Market is still trying to go up. We're going up. We're going up. We're going up. Okay. Then, mysteriously, as if almost this head and shoulders right here that formed at this time was meaningful, the market decided that it no longer liked the price of futures below the price of Bitcoin anymore. Now it liked the price of futures above Bitcoin. And it said, that's the way we should go. We're going to go above, above, above. And we went down. And so we sort of kind of, made a little bit of a fake out here, and we came down, and, we came down some more, okay? And at the time when futures were very closely aligned, we were coming down, a little bit below, but otherwise rather closely aligned, okay? But at the time when futures were very much separated, well below the price, we were going up. Up, up, up. Here's your sign right here. Here's your opportunity to buy right here on a futures signal, right? So this definitely backtests very well. just looking at it, any of these places where futures really, really dipped below, they could have been great buy signals. Any one of them, right? Why? Because later on, we went right back up. Okay, and any time when one of these future signals was one of these future lines was right in line with one of the prices, we were going down. Okay, here we are going up. This was a little bit. This was the one time that it seemed to not work, right? And that's what I'm talking about. Is it definitely doesn't always work, and it's not. It's going to always not. It's going to not always work. That's for certain. Count on it. Adopt your strategy. Test your strategy. Work your strategy. Make sure your strategy is profitable. Plan for profitability. Don't do what I'm telling you to do. Do what you think is going to work, what you've proven to work, what you have made work for you, both in the past and moving forward. And I hope that it makes you really, really profitable. Yeah, at the cost of the interest. That's yeah. If you choose not to exercise the contract, that's exactly right, Caleb. You absolutely pay um, a price on the interest for this contract. I was kind of simplifying it. If you want to know more about futures, definitely go and investigate derivative contracts because they're cool. They definitely allow you some opportunities, and I'll be talking more about them on Friday coming up here about how to use futures as a hedging option to hedge your bets when making very large bets, because you can use these as a tool to do this, and I'll talk more about that. Anyway, I'm going to wrap up this session for this evening. I hope to see you on Slack, on Reddit, in the whale room, and all of the places that we talk. I hope your trades are profitable, and I really do encourage you to really strongly consider planning out your trades, trying things, not just back testing them, but forward testing them. Plan the trade and then trade the plan. And it isn't until you're sure that you will be profitable, and that's when I suggest that you go and try and make yourself profitable. I hope to see you all Thursday and Friday, and have a good evening. Good night.